Hello and welcome back to Chart Pattern Trading Masterclass by Wealthy Education. In this video, we'll talk about using and mastering Fibonacci tools. So, Fibonacci is a somewhat controversial part of technical analysis. It is based on a mathematical formula that is found time and time again in nature. And it basically is a sequence of numbers like 1 plus 1 equals 2, 1 plus 2 equals 3, 2 plus 3 equals 5, 3 plus 5 equals 8. So what you're doing is you're taking 1 plus 1 equals 2. Then you take these two numbers and you get 3. And then you take these two numbers, you get 5. You take these two numbers and you get 8, and on and on. It's there are a lot of places in nature where Fibonacci ratios come into play. The golden ratio is 61.8%. So basically what it means is that there's like an evenness of distribution of 61.8% of a particular number. So people will observe this like in crop circles, the bends in rivers, bends in mountains, et cetera, came out in the I believe 1300s on from a guy named Fibonacci. And he basically kind of came out with this pattern in Italy in the 1200s, but there's also signs that it came out in Indian mathematics is possibly as early as 200 BC. So we'll see. You also have Fibonacci sequences just showing a lot of changes in nature. Now, here's the thing. Fibonacci works because people think it works. Would probably be the best way to describe it. So for example, you'll notice that a bunch of numbers appear. Now, the first thing that I'm going to do is I'm going to show you all of the Fibonacci numbers that are available on the Fibonacci tool, Fib retracement tool. And there are other Fibonacci tools that you can use. So these are all the Fibonacci ratios that you can use on a retracement. So if I pull this all the way down here, maybe on the weekly, you can see that in a downtrend from top to bottom, you can see all of these ratios. Same thing in an uptrend. So you're just basically going from swing high to swing low in this case, because you're thinking, okay, it's a downtrend. Notice how we popped up here to the 50% and then fell off. Now, here's the thing. With Fibonacci, there's only a couple levels that people truly pay attention to. And that is going to be, sometimes you hear 23.6, but in general, not. So you're getting rid of a ton of Fibonacci numbers. So 38.2%, 50%, 61.8%. Here's the catch with the 50% retracement. So we fell, we pulled back 50% of the time. That's an old Wall Street trick. It's not even actually a Fibonacci number. So Wall Street would do things like enter on a 33% pullback in that direction, thinking that the trend had asserted itself. If they didn't do that, they would do like 50 or 66%. Well, that comes out to roughly the same. But I've simplified the Fibonacci retracement tool for you for the numbers that people care about. You have to be cautious because some people will use Fibonacci in this way. So we put that one up. Well, that's a swing high there. So we put that one up. And if it pops up here, we've got this one and this one confirming both, depending on where you draw it from. And you got that. So that's 38.2%. You know what I mean? So you could go on and on and on and just really go over the top with it. So you have to be cautious. Fibonacci is something that can give you an idea of where support and resistance may occur, and therefore give you an idea of where you might want to look for a potential trade. They are not the be all end all of markets. We rallied here. We pulled back to the roughly 61.8% level. We pulled back there again, formed a double bottom, and then rallied. Again, not the be all end all of everything, but at least gives you an idea where people might be willing to get involved in. So let's go from Alibaba to something crypto. So you can see here that we blew through the 61.8% level. So it doesn't mean that it has to work. And in fact, it didn't there. Um, the problem is now that we're clearly in a downtrend, we've pulled back to the 50% Fibonacci retracement level and then went higher. So you can see you can't just willy-nilly use Fibonacci. However, what you can do is look for some type of setup. So let me go down to the daily chart and see if I can find a decent setup. We turned around and we pulled back to the 50% right there. Is this a decent setup? I mean, maybe you would want some other type of um, confirmation. So there's the 50-day EMA. It's sitting on that. It drops down below there. I suppose you could do that. You could do, we rallied here. The momentum is dropping in the MACD. That might be a signal as well. Let's see, RSI. RSI really didn't tell you anything. Shouldn't be a huge surprise. It does need kind of an extreme. So, I mean, you can make an argument that it's kind of like a support and resistance line. It gives you a heads up as to where you might want to be looking. There's also, click on this, Fibonacci, trend-based Fibonacci extension, which is a Fibonacci extension. So you click from, in this case, swing low to swing high. And you can see that you can be aiming for, it's almost like you can think of it as a retracement and reversal. So we extended, we got all the way up to the highs. And let me see here, find a cleaner example. Let's do the Ethereum markets. Get rid of the drawings. So what this represents is, so that's 100% of the original move, right? And this represents a doubling of the move. So you pull back, and then at this point, you're looking, where could the market go? Could it go? Could it double the move? Well, we've already done that. Could it only be 38.2%, 50, 61.8% of the move? These are projected moves. You can, let's see. You can use it on a short-term chart as well. So of any drawings. So here's an interesting one. I'll do this on the hourly. It'll just be easier to show on the chart. You can see that we had a vicious move. And look what ended up happening. It came back here and then it tested that bottom. And then eventually it hit the doubling effect. And now it's much lower. So somebody who was using this to trade this probably would have had their target set here, their stop loss behind here, and maybe a second profit target there and a third profit target down there. It kind of comes down to what kind of trader you are. Typically, you get one, maybe two. To get to the third or the fourth one is a bit of a stretch. That's a complete trend change. For what it's worth, this is actually a market that's in an uptrend. It just had a brutal couple of days. You could have also done this, and you can see that we did in fact hit the first one, didn't hit the second. Doesn't mean we won't eventually. So these are like areas of potential support resistance. You never really use them alone. You want to see some type of candlestick pattern, maybe an oscillator like MACD or RSI come into the picture and tell you the same thing. It's My experience has been you find a lot of luck with it because a lot of people use it, not necessarily because it has any inert value other than that. But that's exactly what you need to make a market. You need, if you're buying this pair, you need people to be doing the same. So it's a nice secondary indicator, maybe tertiary indicator, but it is useful in that sense. It's like anything else. It's like building a house. The more components you have of stability, the better off you're going to be. So if you have moving averages, you have Fibonacci, um, all moving in your favor, then yes, you have a real shot at um, being successful. In this case, you could even have a trend line. Did we break the trend line? Looks like we broke the trend line during the previous session. Again, trend lines can be drawn multiple times at multiple places. So maybe this is where the market stops. Right there was previous resistance, so market memory would suggest support. Again, a lot of this seems to be, there's a lot out there. But really, at the end of the day, it's about stacking the odds in your favor. So the more you can put in your favor, including Fibonacci, the better off you're going to be. So that ends module 1, chart pattern trading foundation. In the next module, we're going to start taking a look at the most bullish chart patterns.